March was an amazing month for the S&P. Not so good for the NASDAQ, but year to date, both have had amazing times. But you might be surprised that the NASDAQ's not doing as well. This is the chart just for March. S&P is in purple here, up 2%. Does not include dividends. Look at the NASDAQ, down 0.36%, which is kind of surprising considering NVIDIA. NVIDIA has been flying high, has not stopped since the beginning, since last year. It's absolutely incredible. I'm actually surprised by this. I would have guessed the NASDAQ was up in March, and I would have guessed it had beaten the S&P. Now, year to date, let's look at it. S&P beating the NASDAQ, up 10.05% versus 8.42% on the NASDAQ. Again, I'm very shocked. Why is this? Well, I really don't know. I mean, the high-flying stocks at the beginning of the year were these tech stocks, so you'd think that the NASDAQ would be up like crazy versus the S&P. But it hasn't been the case. Now, where do we stand for valuations? Guys, if you're new to the channel, I put together my own stock market to GDP ratio going back to 1928. This is what Warren Buffett considers the most reliable metric at any given time. Now, I'm going to hear the junk in the comments like, oh, it doesn't matter anymore, GDP, because company earnings. I'll get to that. I also have the 10-year cyclically adjusted PE ratio, and both are screaming little bit of warning signs. Doesn't mean you should act. It just means be prepared. Right now, as of March 31st, the S&P finished at 5,254, which is a 1.88 ratio, which is almost 100% overvalued based on history. Again, based on history. But we don't know, as the gold saying goes, we know what the market's going to do. We just don't know when. All I mean about this is, guys, just be ready for the next 10 years to not be as good. But there'll be great opportunities along the way to buy great companies. Because whenever you have a 10-year run that's amazing, the next 10-year run sucks for the stock price. However, the fundamentals of the businesses still get better. So what I want you to remember here, as you're doing this, if you bought a company like Microsoft at 300, and it's currently at, what I don't know, but 450, whatever it's at right now. If it happens to fall to 200, and I'm not saying it will, you should sit there and remember, I loved it at 450. I bought it at 300. How are the fundamentals now versus then? If they're better, you've got to remember that that is your indication to keep buying if your analysis justifies it. That's what I want everybody remembering. It's very difficult. You don't want to pay attention to Mr. Market. This is what the market does in the long run. This is what Mr. Market does to you all the time. He is euphoric and happy. He's depressed and sad. You need to decide for yourself, when are you a buyer and when are you not a buyer of stock? Now, this is the chart of all these data points going back to 1928 and the projected returns. Guys, we're sitting here right now at 1.88 ratio, which is right about here. What's that mean about the return? These are the returns. This is the ratio. Okay, I look at this going, that is not good at all. We're not expecting good returns for the next 10 years. But again, it doesn't mean sell. You need to sit there and stick to your process. And your process is something in the future. Now, if your low-cost ETFs are meeting all your retirement goals and you're putting that into our retirement calculator that's part of our software in order to understand, if you have 10 or 20% of your money and you want to buy individual stocks, as long as all of your other ETFs are hitting your goals, then I don't mind it if you wait. I do the same thing. I have all my other goals hit with my real estate, my businesses. I don't mind sitting in cash. And guess what? Cash is paying pretty good penny these days. You can sit on 90-day treasuries that pay an annualized 5.4% return for doing nothing. I love that. It beats inflation. You put a little coin in your pocket and you move on. You wait for the right time to buy. But remember, for your long-term ETFs, as the market goes like this, you got to keep investing along the way because over time, you will average this. You'll overpay sometimes and you'll underpay sometimes, but you'll pay the market average along the way. And that's what's very important. You need to stick to that. As Peter Lynch says, everyone has the brains and the brain power to make money in stocks, but very few people have the emotional control to be able to hold for the long run and make a lot of money. That's what I'm trying to teach here on this channel. Have the emotional control after you've made the great fundamental decisions to put money in a low-cost ETF or buy an individual stock. You need to be able to have the emotional control because news follows the stock price. When the stock market goes like this, The news isn't over here saying things are bad. The news is over here saying things are bad. When stocks go like this, the news over here isn't, oh, stocks are wonderful. The news over here is stocks are wonderful. We've seen that all throughout history, and I'm going to show you that right now in a great chart. This is the S&P 500 ETF going back to the mid-90s. Guys, if I told you could buy here or here, where would you choose to buy? Obviously right here. If I told you could buy here or here, where would you choose to buy? Obviously right here. If I told you to buy here or here, where would you buy? Obviously right here. If I told you to buy here or here, where would you buy? Obviously right here. Now, can I make a comment here? When was news the best? Here or down here? News was best up here. Was the news best here or here? Guys, this is the financial crisis. People thought the world was falling apart here and there was going to be no more money. When was the right time to buy? When things looked the worst. This was COVID right here. When we thought the world was shutting down forever. When was the right time to buy? When was the news the worst? It was here. That's my point. It's easy to look at it in hindsight. The old saying goes, we live our life going forward, but we learn looking backwards. It's something to that effect. We're going to sit here, and if you can remember these things right here, these are the fundamental things you need to remember about when was the best time to buy and when wasn't. There's always going to be a story about why it's a terrible time to buy. And that's why buying low-cost ETFs is so important. You can buy the major indexes and not worry about are they going away, not worrying about what companies are inside of them or outside of them. Guys, we all make these emotional decisions. I have story after story. Back here, I helped friends right here in 06 or 07, and I asked them, hey, if stocks fell in half, what would you do? And the wife said to me, well, we'd buy more, right? Absolutely. Great. She gets it. Fast forward to right here. I get an email. Paul, what's going on out there? I'm worried our money's going to go to zero. What are you doing? Well, like our meeting said, I'm buying more. You're actually buying more? Yeah, that's what we talked about, remember? She says, I'm selling everything. Oh, okay. And I remember thinking to myself, wow, she said something totally different than what she did. And that's the key there, guys. When emotions are running high, you've been there, I've been there, everyone's been there. Warren Buffett's been there back in his early days. The ones who do the best, the ones who keep their emotions in check. And that's hard. Why? Because you're at home alone. You're sitting there watching the TV. You're getting the news all the time going, oh my God, the news is worse and worse every single day. Which is kind of hard to believe because the news today is things are wonderful, things are great, economy is growing, stocks are going up, NVIDIA is changing the world, etc. But rarely is the news accurate. It's usually overexcited, Mr. Market's overexcited and euphoric, or he's depressed and sad. We've all been on both extremes. And when we're in both extremes, it's hard to pull back and say things are going to get better or things probably will be a little bit harder in the future. And that's exactly why I created the software in the community. I needed to have the software, which I use every day, which the people in my office use every day to make good, fundamental, analytical decisions on buying investments. But it doesn't stop there, guys. I need to be able to remember those fundamentals. But when my stock is going away, I don't like it, which is going down, I've got to remember those fundamentals. I've got to be able to sit back, talk to our community members, make sure I understand my emotional side of things, and make sure I remember about the fundamentals. I'm not the best investor in this community, but the best ones are the ones who sit there and look at red days as an opportunity, which is a lot of people in here, the vast majority. Investing is a lonely road. We're out there by ourselves, looking and listening to the news. It can suck. It can weigh on you. And if you don't have people around you to talk to, what are you going to do? You're going to make bad decisions. We've all done it. But if you're able to talk to somebody and they bring it back to reality, because somebody in that community has been where you are or where you're going. Somebody can sit there and say, remember what we're learning here, because that's what we're really trying to focus on. So you want to make less emotional decisions that cost you money? Click the link below, join the community. It's only $7 for 7 days to try it out. This is not a permanent decision. This is an informed decision. Get yourself in, use all of these tools up here to help make your better decisions, but more importantly, the community to help you make better emotional decisions that will make you more money in the long run. So click that link below. Now, for those of you who question the stock market GDP ratio that Warren Buffett, the best investor of all time, loves, there's another one I want to show you guys. It's called the 10-year cyclically adjusted PE ratio. What this ratio does is very, very simple. It goes back and takes the last 10 years. The last 10 years, all the profit levels. And it takes inflation and brings all of them into today and takes an average. And then it takes our stock market price and divides it into that. So basically, you're factoring in the earnings of the companies, no matter where they're located. So for those of you who attack GDP, stock market GDP, and say, well, it doesn't include money earned abroad, this doesn't care. It just cares what was the profit of this company as a company. It brings it to today. Guys, it's actually worse. We're at 105% here. We're at a ratio of 35.14, and the average is 17.01 historically. This is high. Now, during the tech boom, I think we got to 44. So we're still below the tech boom, which makes this look not so bad. But the stock market GDP is worse than the tech level. Guys, all this means is the next 10 years probably won't be great. And it makes sense. What this says is you're paying 35 times last 10 years profit on average. Well, if you pay a lot for something, are you likely to make more money or less money? You make less money. What we want to do is get to a much lower level. Look at where it was back in 1982, the all-time low of all these valuations. Back in 1982. Look at this, guys. It got as low as 6 or 7. Look at this. 7.8, 7.4, 7.18, 6.95, 7.26, 6.64. This was the low right here. That was the low. August of 1982. Now it makes perfect sense. If you bought here, look at your returns for the next 10 years without dividends. 11, 12%. That's incredible because the average is 6.6%. Almost double the 10-year average. That's incredible. Now, let's go to the tech boom of 2000. The tech boom of 2000 had a peak of 44.19 right here, December of 1999. The next 10 years, negative 7.78, not including dividends. Guys, it's just logical. The more you pay for something, the less return you're going to get. This iPhone is worth $1,000. If you pay $100 for it, you're making 900% return on your money. If you pay $900 for it, you're making 11.1% return on your money. It's very simple. So guys, if this makes sense to you, don't forget to sign up for the community at the link below. And also, if you want to learn about the 30 stocks that I want to own forever, watch our next video where I go through them thoroughly. Thank you for your time.